The International Monetary Fund has issued one of its starkest economic alerts for the United Kingdom in years, landing just weeks before the Chancellor's autumn budget. The assessment raises searching questions about Britain's economic trajectory, the government's fiscal choices, and how global investors now perceive the UK. It's already spurred headlines. The numbers are a setback for the Labour government, which has put boosting living standards at the center of its mission. Here's what the IMF actually said, why it matters, and how it could reshape the economic conversation in the months ahead. Rachel Reeves faces a fresh challenge as UK living standards are projected to grow more slowly than almost any major economy in 2026. The IMF forecasts UK GDP per capita, a common proxy for average living standards, will rise by just 0.5% next year, while the Chancellor has acknowledged that tax increases may be on the table in the upcoming budget. In the IMF's October 2025 World Economic Outlook, the UK is set to deliver the weakest per-person growth among advanced economies in 2026. The contrast is sharp: 0.5% in the UK versus 1.8% in the US, 1.2% in Japan, and 0.9% across the euro area. The fund also expects the UK to have the highest inflation in the G7 over the next 2 years, remaining elevated even compared with countries like Peru and Senegal, as higher taxes and rising household bills keep price pressures stubborn. What makes this especially jarring is the comparison itself. The UK, one of the richest, most developed economies, now looks set to post inflation rates above those of countries that typically grapple with greater price volatility and currency swings. Those economies often contend with weaker institutions, smaller financial systems, and heavier commodity exposure. Yet the IMF suggests UK inflation will run hotter. That's alarming because it implies Britain is no longer behaving like a low-inflation, highly stable economy. Instead, it's showing price dynamics more often associated with emerging markets, despite having one of the world's oldest central banks. The question is why UK inflation has been so sticky. Structural issues such as energy dependency, a softer pound, and tax-driven cost pass-throughs all play a part. In short, the IMF isn't only flagging sluggish growth, it's warning that the UK faces inflationary forces more typical of developing markets. IMF downgrades aren't casual. The fund's economists scan fiscal and monetary conditions across roughly 190 countries. When they shift their view, it matters. The IMF nudged its 2025 growth forecast up slightly, from 1.2% to 1.3%, but trimmed its 2026 projection to 1.3%, citing concerns about the Labour government's policy path. The reasons for the downgrade are layered. First, inflation remains unusually persistent, sustained by energy costs, pricier imports, and robust wage growth. Second, business investment is subdued after years of political churn and regulatory uncertainty. Third, with the Treasury confronting a roughly £30 billion fiscal hole, tighter spending and further tax rises appear likely, moves that could break growth further. Notably, the IMF called the UK's inflation stickiness atypical for a developed economy. While core inflation in the US has edged closer to target, UK price growth, around 3.8%, remains well above the Bank of England's 2% goal. So why is UK inflation the highest in the G7? The drivers are the same trio: energy costs, import-led price pressures amplified by sterling's weakness, and ongoing wage dynamics, weak investment after prolonged uncertainty, and the drag from looming fiscal consolidation to close the deficit. The cost of living crisis has shifted form rather than vanished. From the 2022 squeeze in energy and food to today's pressures from housing, services, and taxes. Politically, persistent inflation doesn't just erode purchasing power. It dents trust in economic stewardship and tests central bank credibility. Food inflation rose for a fifth consecutive month in August, with prices for beef, butter, milk, and chocolate pushing annual food and non-alcoholic drink inflation to 5.1%. Even so, slowing price rises in areas like airfares kept headline CPI steady at 3.8%, unchanged from July. Another troubling element, though not explicitly flagged by the IMF, is the UK's steep borrowing costs. 10-year gilt yields are now consistently the highest in the G7. A chart of benchmark yields tells the story. Despite UK public debt being middling by international standards, about 100% of GDP versus roughly 135% for Italy and around 240% for Japan, Britain's borrowing costs are higher. Greece, with debt still above 150% of GDP, can borrow at roughly 3.3%. The symbolism is striking. The UK, a historic financial heavyweight, is paying more to borrow than Italy and Greece, economies long linked with fiscal fragility. That shift is not just cosmetic, it's economically consequential. Bond yields are a confidence barometer. When investors buy gilts, they're lending to the government. The yield compensates for the perceived risk. If UK yields sit above Italy's or Greece's, markets are effectively assigning a credibility discount to Britain, demanding a premium not due to insolvency, but uncertainty about long-term direction. Historically, Britain's lower debt load would mean cheaper funding. Today, the reverse holds. The takeaway: investors are less convinced about the UK's policy path and long-run stability. The IMF isn't the only source of alarm for the Chancellor. Prominent global investors have voiced similar concerns. Lean too heavily on tax rises to fill budget gaps, and you risk chasing away the talent and capital the economy needs. Ray Dalio, founder of Bridgewater Associates and a widely followed market thinker, recently warned that the UK is stuck in a debt doom loop. In his framing, rising debt service costs force governments to either tax more, driving out investment and high earners, or borrow more, swelling the debt and pushing interest costs even higher. The loop reinforces itself: heavier debt burdens, weaker growth, shrinking tax bases, and mounting social and fiscal strains. Dalio argues the UK is more exposed than the US, Japan, or Germany. America benefits from issuing the world's reserve currency. Japan enjoys deep domestic savings and is a net creditor, with strong home bias for holding JGBs. The UK lacks those cushions and relies more on foreign capital. When confidence slips, as during the 2022 mini-budget crisis, yields can spike rapidly. That vulnerability, Dalio suggests, is why Britain appears already trapped in the loop. Pressed on why UK borrowing costs exceed those of the US, Germany, or Japan, despite smaller deficits and lower debt ratios than some peers, Dalio was direct. Sterling is no longer treated as a reserve asset or reliable store of value, and the UK lacks Japan's domestic buyer base. The US still enjoys global demand for dollars. Japan's investors tolerate low returns and currency weakness due to strong home bias and creditor status. The UK has neither. As a result, international investors demand higher yields to hold gilts. In essence, Britain pays more because markets are less confident in its long-term fiscal and macro framework. That leaves Rachel Reeves with a narrow path ahead of the autumn budget. The tax burden is already the highest since 1951. Debt is at modern-era highs, yet additional tax measures look likely. Raise taxes, and you risk accelerating capital flight. Avoid them, and deficits swell. Political constraints compound the difficulty. Despite Labour's large majority, proposals like trimming winter fuel payments for pensioners or tightening personal independence payments face resistance from the backbenches. The very reforms investors view as necessary are the ones hardest to pass. That's why the upcoming budget is pivotal. Reeves must steady markets, manage her parliamentary party, and bring the public along. Every decision on taxes, spending, and borrowing will telegraph the UK's direction. If she can restore credibility, Britain may ease out of the danger zone. If not, the UK could sink deeper into the debt doom loop Dalio describes. The stakes couldn't be clearer.
If you want the background on today's price rises, watch Tax Hikes versus Growth we recently published.